What if you're not 100% sure an interest rate risk will arise? Now, unless you're absolutely sure, consider using an option. This gives you the flexibility to walk away from the deal. Examples would include an acquisition or a project which fails to go ahead, but where the potential financing costs have been hedged prior to the anticipated deal. So let's take an example. Let's look at what happened to Harvard Business School, the renowned college in the States. In anticipation of various projects for which it had lined up funding, Harvard entered into some interest rate swaps where it paid fixed. It had an average cost of about 4.7%. So it had locked in the costs of its borrowings to be. We then moved into the financial crisis, which resulted in many of the projects being postponed. Now this meant no funding was forthcoming, so the projects just weren't going to happen. So Harvard's got a problem. It's left sitting on swaps it didn't need and that weren't hedging anything. Even worse, rates fell sharply, so Harvard was stuck with paying high rates while offsetting swaps were much lower. In other words, it was going to cost a small fortune to unwind or terminate these swaps. Now, the banks were asking Harvard to put up money to cover these losses, but their investment portfolio was now underperforming. So liquidity, or cash on hand, was scarce. It was a sort of double whammy for Harvard. Well, it cost Harvard nearly $500 million to close these out. And in addition, they agreed to pay another $425 million over the next 30 to 40 years. What the clever guys in Harvard should have done was use options to enter into swaps. We call them swaptions. So when the underlying deal falls away, they would only have lost the option premium and not been stuck with such large termination fees. So the bottom line is, unless the exposure is real, think about using options instead.